Welcome back guys to another Zero DTE video, and today Ernie's going to be going through at the money trades, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's course. And as always, I hope you enjoy guys.
All right. When I'm talking about at the money trades, this is what it's going to look like. We'll create a risk graph here, and then this is at the money, whatever price it is. This morning, I don't know what it was, 45.20, maybe 45.50, somewhere around there. But when you put on a butterfly, it'll look like a 50 wide butterfly, and then the real-time profit curve. So this price of this fly will be the risk, or this cost, the debit. It'll be the width, which is 50 minus the debit. Now, on a trade like this morning, it was around $28. So that means that the potential here to there will be $22. So if you were to hold on to this trade, enter it here, and then hold on to it all day, and it entered right at the center strike, you would make $2,200. But that's a very low probability of something happening. So instead, what we want is we want to see some premium decay. We want this thing to go up a little bit like that. And of course, it has to stay in between these strikes. Actually, we would like it to stay in between these strikes, which are the break-even points. So there's break-even 1 and break-even 2. We're looking for this difference in price right here. And what most strategies look for is about $1.50 or $150. And that can happen somewhere between the first 5 minutes to 20 minutes that you're in the trade. Now, of course, you're assuming then this range here is going to expand and that you'll have pretty good luck to stay inside of whatever that range ends up being. It's going to start out virtually nothing, about here to here. And then as premium decays and grows into this guy here, you'll make this profit right there. And you might think, well, man, what if it doesn't decay? And there are a few cases where it might not decay or might get delayed in decaying. And that is if implied volatility for the day, for the morning, remains high, or it starts low and then increases. That will, in some cases, even depress this profit curve and bring it down. And so you could experience a loss, even if you're sitting right in the middle. That's a possibility. But the truth is that this ultimate thing that we're looking for happens about, 65 to 70% of the time. That's what we're looking for. We're looking for that small little profit. Now, most strategies like this are adamant that you get out when you hit $1.50 because the risk of price moving back and forth or staying in the middle is relatively low. So once you hit that $1.50, you get out, be happy, and you go on. Now, what you're doing, though, is you're looking to risk that $28, which is the debit, to make $1.50. That's an insane risk to reward. It's an insanely low risk to reward. It is a hugely risky trade. Now, a lot of people will claim that, well, I can mitigate that risk by being extremely diligent and adhering to these break-even points here and not allowing them to exceed maybe double that risk, or $3. And that's the goal. Now, is there any way to kind of guarantee that? Can you guard against quick markets at the open? Well, the only way to really guard against a very quick market at the open is if you have a pre-entered trade or a limit order that will get you out should the market either drop or go up. So you have to really put on 2 additional orders. Plus, you'll want to also put on an OCO order, an order cancels order, to close the original trade or close the other order. So if one of these gets executed, then you want this one to close. You don't want it to be hanging around. You don't want to forget about it. Really, you want it out of there. So you need what's called an OCO order or order cancels order. You can also manage this by eye or actively and take your chances, but probably not a good idea. So that's the basis behind this type of trade. Now, what are some of the problems with that? Well, one is that about 30% of the time you're going to hit that risk, or $300. So that leaves us with, well, what is the expectancy, long-term expectancy, if that happens? All right. So we can do that by looking at an options expectancy calculator. All right, let's plug in the numbers. Let's say that our probability of winning is 0.7. I think most people will agree that it's about 0.75%. And the average win is fixed at 150, and the loss is fixed at 300. All right. So that's saying that you trade this thing over 100 trades, and you can expect to make $3,750. Now, what happens if we get up to an 80%? Just by increasing our odds to 80% is a dramatic difference in terms of the amount that we can make. So you can see that this can vary widely. So let's just put range. Let's say it's between 0.7 and 8, same win and loss characteristics. All right. So there's a huge disparity between there. I mean, at 70% win rate, after 100 trades, that's only $15 per, average of $15. You're going to return $1,500. But if you can increase that to 80% somehow, then you can return $6,000. That seems like quite a range. I'm not sure exactly how you would justify a trade like this. And it's certainly not something that you can scale readily because the risk in this trade is just monumental. You don't want to really fool around with this. If you have just one bad beat, it could wipe out the returns from 100 trades. So while this is an extremely popular strategy, I don't know. To me, it's just way too risky.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.